Yves Bonzon, Chief Investment Officer at Pictet Wealth Management, believes that gold is a canary in a mine, not a black swan. Yves, welcome to the studio.
Good afternoon, Nicolette.
So this gold slump, it's not really a surprise, it's more an accident. It was more an accident waiting to happen.
Well, actually, it had to happen at some point, not the crash-like pattern that gold followed in late March, early April. But what's interesting is that actually this sort of crash that happened, this black swan, captured investors' attention at the time and has actually hidden a much more important story unfolding behind the scene. Therefore, the idea of the canary in the mine. More than the collapse in the gold price, what matters is the relationship of gold with the other alternative real assets, which are equities. It's, in a way, the battle of the productive assets, equities, versus the unproductive assets, the precious metal as a store of value. What's been going on is, for the first time in 10 years, equities, US equities in particular, have substantially rallied with a simultaneous decline in the gold price. And this has never happened, essentially, since 2003, when the Federal Reserve first dropped interest rates all the way down to 1%.
So this is a very bullish sign, because the US recovery has been much slower in this cycle than in any previous cycle.
That's true. We think that the recession that has affected the United States since the crisis of 2008 is a recession of a kind that was never experienced since 1945. Some have coined the term balance sheet recession to describe the phenomena at work. What happened is, because excess debt had been accumulated by households in the United States, after the crisis and following the collapse in real estate values, credit demand completely disappeared. So the central bank tried to stimulate the economy with interest rates cut, but the system was no longer responding. As long as the economy is affected by such a situation, no credit response, equities can have a sustainable rally under monetary stimulus only. But this monetary stimulus, as long as the credit mechanism is broke, benefits precious metals more than equities. Therefore, having a rising equity markets coupled with falling gold price is of the greatest importance in terms of signals, and it tells us that there's a big regime change going on in global financial markets.
But to come back to the weakness of the cycle, I understand that you believe that it's due to two main reasons: the weakness in the expenses of the state and the delay in the reprisal of construction.
Yes, and that was of course related to excess inventory in the housing sector and the huge job destructions that have happened in the real estate sector. As we can see, jobs that have been destroyed in the housing crisis have barely recovered, whereas in the rest of the economy, most of the jobs lost have been actually regained. So there's been a dichotomy which has substantially slowed the recovery. With housing now turning the corner, with inventory being significantly reduced, prices starting to move up across the country, there is a new cycle that is emerging, a much more virtuous cycle of growth, and we think that's extremely beneficial for the economy. If you add to this the tremendous cost advantage in energy that benefits the US following the shale gas revolution, you have a situation where the marginal return on capital is improving in the United States relative to the rest of the world. That means we probably will have a virtuous dollar bull market cycle, one of the kind that we experienced between 1995 and 2000 during the Internet revolution, and a virtuous rise in the US dollar is a very, very different investing environment as compared to what investors have experienced in the last 10 years.
But they still reason in the same way as they have in the last 10 years.
They do. What I do observe on an anecdotal basis in meetings with investors of various kinds is that portfolios are very much tilted still toward asset classes such as emerging market, such as gold, and few others that have been the best performing asset classes from 2002 until late 2010. We've seen a rollover in the relative performance of these asset class back towards, in particular, developed equities, which are leading the way now.
And the other help to retrieval is going to be that the states are going to start hiring again, the US states.
Yes. We've had a big dichotomy in the last few years. The federal government was stimulating the economy, and therefore the significant budget deficit that the United States has had for a few years now. But at the same time, local governments, cities, were cutting back significantly on their spending. For the first time this year, they will actually start to grow spending again. So we have a modest offset to the current fiscal correction that the federal government is proceeding with.
And US equity, is it outrageously overpriced?
I would say the following. Fundamentally, they are, in my view, on traditional mean reversion models, probably some 20% or so overpriced. With the caveat that, as always, valuation is at the frontier between art and science, so one has to be prudent with these measures. But probably a few percentage points overvalued. But what is the market pricing fundamentally is what is of the greatest interest. We have record corporate profit margins. And the market is partially pricing a reversion to mean of these profits. So the market does not, as we speak, price current profitability as sustainable. It is my view that probably they will eventually mean revert these profit margins, but to a lesser extent and later than investor discount. A factor that could accelerate this mean reversion is if governments, maybe at the G20 level, find a way to actually increase corporate tax rates, I mean effective tax rates, because they've basically halved in the last 25 years. And that's been one of the factors behind this tremendous expansion in profit margin that resulted from the globalization cycle. So a market that is slightly overpriced on an historical basis, not hugely so, but that is probably prematurely pricing mean reversion in profits, but also very important, a market that, in my view, is, especially for non-US investors, is under own. I see a lot of emerging market exposure. I see a lot of gold exposure. I see a lot of direct and indirect commodity exposure in portfolios. I see very little good old blue chips, nifty 50 ways.
Yves, thank you very much for joining us today.
My pleasure, thank you.